Hi there, I'm Dan Ferris, and I am the editor of Extreme Value, a value investing newsletter published by Stansberry Research. You can find more about that at stansberryresearch.com, and you can subscribe to it at extremevalueoffer.com. We don't do refunds, okay? I want to talk to you today about the sort of crowded trade, if you will, of our time. And I want to talk to you about the potential for really big losses and what happens when people just put all their money into one thing. And it's really weird because the thing people are putting all their money into today, as we'll show, is in just one little sort of almost anecdotal way, is the overall stock market. It kind of is, it's a head scratcher because what do you do? You know, it's one thing if everybody wants to get out of mining stocks or if everybody wants to get out of bank stocks or any other kind of stocks. But if everybody wants to get out of 80% of the market cap of the US stocks, for example, if they wanted to sell the S&P 500, what happens then? I don't know. So here's where I arrived at this. I saw Bank of America, Merrill Lynch put out their quilt, this chart of the top 10 ETFs by market cap from 2000, every year from 2000 to year to date 2018, okay, first half of 2018. And it shows you, I just kind of admittedly cherry picked a little bit, but the point, if you look at the whole chart, the point is rather well taken, I think. Back in 2009, if you take out all of the doubles, all of the common stocks, all of the ones that are doubled, right, between 2009 and 2018. So you look at the top 10 ETFs in 2009, top 10 ETFs at this moment, and take out all the doubles, all the ones that both periods have in common, and then you're left with the ones that are different between the two periods. And it's kind of interesting because in 2009, the ones you'd be left with would be gold bullion, emerging market stocks, treasury inflation protected securities, and small cap US stocks, Russell 2000. Now look, if you're looking among the largest ETFs, the top 10 or 20 ETFs in the world, that's about as diversified as you're going to get. Gold bullion, small cap US stocks, treasury inflation protected bonds, and emerging market stocks. I mean, that's pretty decent. But if you look at the way it is today, it looks a lot different. The force, after getting rid of all the common names between those two periods, today you'd be left with Vanguard S&P 500, Vanguard FTSE Developed Market, big cap developed market stocks, EAFE iShares Core, big cap developed market stocks, and the iShares US Aggregate Bond Core. That's the total US investment grade bond fund. So basically big cap developed market stocks and US investment grade bonds, which bonds are still, for my money, the biggest bubble in human history since 5,000 years of written history. So it kind of begs a question. When everybody wanted to sell gold, after it started falling apart around 2012, okay, well, gold's not a big market, so everybody can sell that and buy something else, and it's no big deal. Everybody wanted to sell, whatever else they wanted to sell, emerging markets even, or 3D printing companies or solar companies, or just name anything that went absolutely nuts. Social media companies. Just name any kind of bubbly looking trend of the past 10 years. And if everybody wanted to sell it, well, there's plenty of liquidity for that because they weren't that big individually. But the thing that everybody's big into now is big indexes. And in fact, if you look at the top 10, all the top 10 ETFs by market cap, it's just all S&P 500 and developed market big cap stocks. It's like, it's mostly that. And then there's the one US aggregate bond fund, investment grade bonds again. So I would say that, based on the flows into the very largest ETFs, you are looking at a very odd situation. We've heard other people talk about this. A guy named Steve Bregman talked about it at the Grants Interest Rate Observer Conference a year or two ago, a couple years ago, I guess by now. And it's a market in which there is no price discovery. It's a market in which people simply passively buy these ETFs, and in which the thing that's outperforming everything else is the overall market. Okay, we understand when gold is outperforming everything else, everybody pours money into that and it runs up, and we all know that it won't last forever. And one day it'll crash and people go back to buying S&P 500 stocks or whatever else they'll buy. But I can't wrap my head around what happens when everybody wants to sell the S&P 500, which represents over 80% of the market cap of U.S. stocks. It's a head scratcher. Have we been in this position before? Paul Tudor Jones recently came out with a little bit that I think was in Zero Hedge or someplace like that, where he said he thinks this feels a lot like 1987 to him. Well, what happened in 1987? It was like the biggest one-day crash in Dow Jones Industrials Average history. And that makes sense to me. Now that I look at this other little piece of data that Bank of America has put out, and which was tweeted out by Zero Hedge today, it makes sense to me that he feels that way, because in 1987 you had, well, at least the story is, that everybody was running for the exits at once because they had this portfolio strategy that had them selling S&P 500 futures and selling S&P 500 stocks and selling absolutely everything that they could related to the S&P 500, in a strategy that basically told you to sell more if things went down, you sell more. If things go down a little more, you sell more, and it just, where's that going to end, right? And so, it was a big crash in one day. And I'm afraid that we're not just in for volatility because of very high valuations. And we explained in kind of a geeky value investor way in the June 2018 issue of Extreme Value why we think high valuations are going to translate to really high volatility. But I think it's worse than that, potentially. I think there is a risk that we get huge drawdowns in one day in the S&P 500, starting about now over the next year or two or three, or however long the situation takes to sort of right itself. If my reading of what's going on now is right, I can be wrong. I can always be wrong. But it's an odd moment in history. All-time high valuations on the S&P 500, pushing up against all-time high valuations. We hit the all-time high in late January of this year. Most expensive moment ever. And, you saw what happened after that. In 9 trading days, we were down 10%. And that's a pretty quick kind of a move in itself. But, plenty of liquidity around for a 10% drop, right? It doesn't mean anything really, right? But what if it's, I don't know, what if it's like 20% in one day again, like it was in 1987? Can that happen? I don't know, but it looks awfully much like it could. I hate to be in a crowded trade. I hate to be in the thing that everybody owns, and everybody wants to own all the biggest cap stocks. Name the top 10 biggest cap stocks. By definition, that's what everybody wants to own. And all these passive vehicles, that's how they decide what to buy. They get $1 and they put the most into the biggest market cap and the second most into the second biggest market cap and the second, like that. It's market cap weighted. And even float weighted, it doesn't matter, mostly. So where do we wind up? What happens? What happens if everybody wants to sell the S&P 500? I don't even know what that means. Who do they sell it to? I don't know. I don't know where this winds up. Maybe I'm worrying for nothing. And that would be wonderful, wouldn't it? Because we continue to find long ideas in extreme value, and we're going to keep recommending them as long as it makes sense to do so. But this is an extremely weird moment to own big cap U.S. stocks and big cap developed market stocks, and frankly, most bonds still. And as we showed in the June 2018 issue of Extreme Value, things in apparently safe instruments can go bad very quickly, much more quickly than you can react to sometimes. And it can hurt you really bad in a way that you just never anticipated. And no one is looking around this corner with the market pushing back up against all-time highs. No one is looking around this corner right now. And that's all I want to say today. I want you to think about this. Comment below. Write something in the comments below. Just tell me how wrong I am. Be nice. I'm a nice guy. I don't think you're stupid. I hope you don't think I'm stupid, if we disagree. But just, think through this with me. And hit me up on Twitter at dferris1961. Or join the Facebook Value Investor Forum group. And let's just talk about this. Somebody help me wrap my head around it. Okay, so I don't have advice today. I don't have recommendations. I have nothing but questions. And that's where I'm going to leave you. And I will be talking to you again real soon. And we recently hit 666 YouTube subscribers. And I want to thank each and every one of them. I really appreciate it. And here's to 6,666. Okay, let's do that. Thanks very much. I'm really honored to have you all watching. See you next time.